Welcome to the CIO Chair, a podcast hosted by the CIO Investment Club in collaboration with the Pension Insurance Corporation. In each episode, we will sit down with top chief investment officers to explore their unique investment philosophies, decision-making processes, leadership strategies, and personal career journeys. Now let's get started. Welcome everyone to the CIO Chair, hosted by me, Sean Thompson.
And me, Hartaj Singh.
The CIO Chair's guest today is Pete Drewienkiewicz. Pete is now Chief Investment Officer at Gallagher UK, following the recent acquisition of Redington, and chairs their UK Investment Strategy Committee. In this role, he advises a range of institutional clients with combined assets of more than £200 billion, including pension schemes, non-profit institutions, LGPS, insurance companies, and wealth managers. Before taking up this role in March 2018, Pete led Redington's manager research team since 2011, where he oversaw a team of investment professionals responsible for the selection and monitoring of investment managers across both traditional and alternative asset classes. Before joining Redington, Pete spent 9 years working in fixed income and derivative markets at a number of large investment banks. Welcome to the CIO Chair, Pete. It is a pleasure to have you here. I hope you are sitting comfortably.
Very comfortably, thank you. And it's lovely to see both of you, even though I think anyone who's listening won't be seeing you.
So, Pete, the first thing I'm going to ask is, did I pronounce your surname correctly? And also, perhaps you could just give us a bit of background about where your name has come from.
Yeah, that was a pretty good stab, actually. Although I have an anecdote that I have to share around that, which is that when I turned up at Redington in 2011, I was told quite quickly that I was apparently mispronouncing it. But a wonderful colleague of mine, Kate Miakowska, who I don't know if you've come across, who's now over at Brightwell. We worked together for a long time, Kate and I. And so, yeah, I basically owe it to her that I actually now pronounce my name correctly. So I'm third generation Polish, and my granddad was a Polish paratroop. And then, very confusingly, my dad then joined the British Army, and he did quite well there. So it all got very confusing, I think, towards the end, with having a British general running around with a Polish name.
Amazing. Thank you for that. Appreciate it. Hartaj.
That's fantastic. So I'm going to call you Pete then, to keep things simple. First of all, congratulations on the acquisition by Gallagher. And so we'll come back to that. But just to start with and to set the scene in your role, what does your day-to-day as the CIO look like?
Yeah, it's a great question. I think there's CIOs in different molds. I think, if you think, off the top of your head, you've got CIOs who are very, very deep in investments. You've got CIOs who are maybe a little bit more sort of talking head types and so on. Some who are very internally focused. And I'd say I'm quite balanced. So I spend a good chunk of my time on investment content. As you said, Sean, I chair our investment strategy committee, which meets every Friday for a couple of hours. I give a agenda and focus for our various research teams and collaborate with them. But I also look after some of our biggest clients and also get involved really in kind of any heavy lifting with interesting and meaningful client problems that pop up across the business.
That's fantastic. And we recently had an in-house CIO in episode 1, Simon Pilcher, and an outsourced CIO, Chetan Go. Mm-hmm. How would you interact with investors like them within your day-to-day role?
Yeah, it's interesting. It can be very, very different ultimately. I mean, there are a lot of in-house teams in the UK as there are elsewhere. And I think that one of the really fantastic areas of business that Redington and now Gallagher has carved out for itself in the UK is working alongside those in-house teams. So one of the phrases that we use a lot is being an extension of the in-house team. And what we want to do is ultimately be super collaborative and do our absolute best to avoid crossing swords with in-house teams or any hint of kind of not invented here syndrome, which we see a lot.
And would there be interaction around top-down strategy, so let's say the strategic asset allocation, or would it be selecting external managers? What are the kind of ways that you might sort of work together?
Yeah, so increasingly with entities with an OCIO setup, whether it's an in-house OCIO or an external OCIO, we work much more alongside the trustees in that strategic focus role. So it's really thinking about long-term strategy, thinking about setting goals, constraints, thinking about really driving towards an outcome, and not being as in the weeds with implementation. We might opine, we might support on a manager selection, or we might support around a particular asset class if we were trying to work together to sort of give the trustee comfort around the new asset class, something like that. But generally speaking, it's much more strategic. And I think that's a real hallmark of the business. I think that's a real hallmark of it's coming up. We'll never make 20 years anniversary now. It's a slight sadness, I guess. But, 19 and a half years, the brand made it. And I think really the hallmark of what Reddington did so well was focus the conversation on what's the client trying to achieve and how do you get there, in a risk efficient way while being, while being risk aware and diversified. And that really, drove a huge amount of success of the business.
So, just looking back, obviously you started your life with investment banks, and obviously here you are today being CIO of a investment consultancy firm. Is sort of consultancy always been something that you've wanted to do? Is it something that just came about and just happened? How did it actually come about for you?
It's a great question. I mean, no, it was very, very much just something that happened. Really, I didn't really know a lot about consulting. Candidly, I had probably a bit of a negative view of it around a little bit of way that people think about teaching. If you can, you do. If you can't, you teach. And I really fell into it, and I was struck by a lot of Simon's comments on your first podcast around luck and the role that luck plays. So for me, luck absolutely played a huge role in getting here.
I'm pleased to hear that you listened to our first ever episode, Pete. That's a great start.
That wasn't a planted comment.
Exactly. So you talk about luck, and that luck does play a part. What would you say? What was the lucky break that you found that you had, or was there any pivotal moments, that you came across along the way?
I mean, I think just it's almost all been luck. I think to some extent, it's not easy to talk about things that haven't been luck, but I mean, right from the start, I was lucky enough to get put on a client when I was starting out in fixed income at Barclays Capital. I was lucky enough to get handed a client that they thought was quite problematic. That client ended up being something of a mentor to me and ultimately leading me to change jobs and move over to UBS, which got me out of Canary Wharf, which was an absolute result, but also opened me up to a more senior and more wide-ranging job, which was fantastic. But then I think the really significant piece of luck came when, I was between things and trying to figure out what to do next in my life. I had a business plan to start a boutique hotel and had raised some equity from some former colleagues to do that. And Rob, who had founded Reddington, who I got to know through a different vein of life, I kind of wouldn't stop calling and just said, look, I really want you to come and run this manager research team. And I kept saying, well, I don't know anything about manager research, so I don't know why you think I would be able to do that. And the rest is history.
That is fantastic. So as you look to the breadth of your current role, I guess one of the things that would be interesting to know about consultancy is, are there any kinds of clients that have to hire a consultant, or is this something that people do to sort of aid their decision making?
Yeah, so there is some sort of regulatory protection in that, there are certain types of client who are supposed to take, some type of professional investment advice. Pension scheme trustees have to have what's called a Section 36 letter for certain decisions and investments. And so on some level, that encourages people to have a consultant. But ultimately, if you've got an FCA regulated in-house team, they can write those and sign those. So I candidly think that although that might have been behind some of the growth in the industry right at the beginning when investment consultancy really sort of grew out of actuarial consulting, that I think since then it's become really about good governance, good decision making, having an expert in the room who has a broad context that can assist with that decision making.
That makes sense. And how is the client roster evolving? So obviously the pension place is very different now than it was 20 years ago. So can you talk me through either the changes in clients you're having or the different type of interactions you're having as a result?
Yeah, well, and we're very, very lucky in that we have a broad client base, and they have, a wide range of very interesting and different investment problems to solve. So you've got DB pensions, that's a big part of the business. And, we are lucky enough to advise on, a big chunk of the market, particularly those that are larger end of the spectrum. But we also work across DC, we work across the government pension schemes. We do work with insurers and also the wealth management arena as well, where we've been active since about 2014, which is again, really interesting. And then probably the most exciting, I think, in the last few years has been the growth of our non-profit charity work. So working across endowments and foundations and charities. And there's been a really strong alignment, I think, there between the sense of purpose that Reddington was founded with and that we still come to work with every day, and the purpose that many, many of those organizations have as well.
And just looking at those charities, trusts, and foundations, obviously the sizes of those firms, the monies that they have to manage can vary quite considerably. So, how do you go about sort of looking after the smaller charities that might be out there? They might be wanting to have some consulting from yourselves versus those are obviously the bigger charities with larger amounts of money. How does that differ?
So I think what's really interesting is that although a non-profit, a foundation, endowment, it's still a complex problem to solve. You don't have the same kind of actuarial liabilities. You've got liabilities that are driven by spending ambitions, but the modeling around those is much lighter, candidly, and much less sort of heavy lifting analytical. And that means that we can make our advisory proposition work for smaller clients with smaller budgets, and ultimately, they can be slightly lower touch in their nature. So I think the smallest charity that we work with is down into the sort of mid-teens millions, and we can have a sort of lighter touch, sort of simpler investment offering for those clients.
That's fantastic. So let's start with let's say a very heavy touch or a high touch client. Could you just take us through all the different processes that you would help them with such that they end up with the sort of portfolio, or you can propose a portfolio that's best for their sort of long-term needs and their stated risk appetite?
Yeah, and maybe I'll take it in stages a little bit, Hartej, and keep it sort of high level and jump in if there's bits you want to know a little bit more about. But we have a process that we call ROSI, which stands for Research, Objectives, Strategy, Implementation, and Evaluation. And as well as being extremely catchy, ultimately it works really well. I think the bit that I'd highlight to start with is the R for research, which is again like a real hallmark of how we've differentiated ourselves as a business. So we spend a lot of time working with stakeholders. Sometimes it's in a workshop environment, sometimes it's via a series of questionnaires to establish what are they really trying to achieve over what time frame and with what constraints. And by doing that and getting everyone on the same page, you save time down the line, because what we then do is we create a one-page framework, which we call an investment risk management framework, which is much less catchy than ROSI, sadly. But if anyone's got better ideas for what we should call it, I'd love to hear them. But essentially, it's your kind of roadmap to meeting your goals and objectives. Both those stages allow you to defease some of the behavioral finance issues that come with investment content, with any type of investment content. And again, one of the things I think we've really lent into as a firm is we're big believers in behavioral finance. We really understand how behavioral issues can derail decision making. And so a lot of our process is really set up to defease behavioral issues at each stage. And those two are the first two. I think the rest of the process, to be completely honest with you, is probably, less differentiated. As you get into the weeds, we're looking across portfolio construction. We're putting a mix of asset classes together that are going to, meet the client's risk and return ambitions. We're using a very sophisticated set of capital markets assumptions to do that, which again, I can talk about in a bit more detail. Implementing via active, passive, or quant managers, using our manager selection team, which is more than 40 people now around the world. And then that reporting back to the client. So quarterly reporting, or sometimes more or less often, and allowing them to then evaluate their progress against their goals and how they've done quarter to quarter.
Yeah, that's fascinating. I'd love to dig deeper into the behavioral finance aspect. I sort of recently listened to a memo from Howard Marks about how he attended a pension consulting meeting, and how sort of risk appetite and time horizon were, and the strength, the covenant of the sort of institution, they were three important levers. But that didn't necessarily mean that if people had a high risk tolerance, that they took lots of risk. How do you make sure that the trustees are taking advantage of all their sort of natural advantages?
Yes, I think one of the things that I was an influence in, not by any means the only influence, but one of the things I remember having a conversation with Rob soon after I joined in 2011, where I said, look, risk isn't bad. We need to be careful not to talk about risk in a pejorative sense, because risk isn't bad. What you want is you want efficient risk. You want to know what your risk budget is. You want to know the risk you're running, and then you want to deploy your risk budget into rewarded risks. And ideally, like a diversified basket of rewarded risks that are going to compensate you through time. Not in a perfectly straight line, of course, we all know that, but you're going to effectively try and use that risk budget effectively as possible to access rewarded risk premia that will take you on your goal. And I think there are a number of issues with that behaviorally, but I would say that, one of them is just that, when things have done very well, we get very enthusiastic about them. Joe Wiggins did a great piece on LinkedIn about gold recently, about how it's the ultimate trust asset, which I thought was fascinating. You look at assets that have done really badly, that have bad periods. Everybody thinks it's the worst thing. Everybody was completely off UK equities. Now UK equities are, coming back, having a much better year this year, as they always were going to at some point. So trying to just move these conversations away from what's done well, what should we be buying more of, what should we be buying less of, and towards, is your portfolio actually on track to deliver the returns in the risk budget that you need to help you meet the goals that you're trying to achieve? Because ultimately, like, what the portfolio did yesterday, to some extent, doesn't really matter. What really matters is, what is it going to do moving forward? Is it going to meet your goals and objectives? Yeah, within those constraints.
And I think on the risk side, there sometimes must be sort of slight frustrations in that you can see the opportunities available for an asset owner to invest in certain asset classes or in certain strategies, duration, whatever it might be, but they're not willing necessarily to take the risk that you'd like them to think about taking. How do you go about having those conversations with them to try and get them to sort of come away thinking around your way of thinking, whilst it still meets their needs, but it's something different to what they might have thought about in the beginning?
So this is, you can lead a horse to water, but you can't make it drink ultimately as an advisor. And that, I think that can be, we haven't talked about that, but one of the sort of downsides or the disappointments of being an advisor is that sometimes you can't get people to do the things that you think are the right thing to do. And there's probably really good reasons for that, some of which might be behavioral, some of them might not be. But I'll give you an example of a number of ways that we've worked over the years, is really thinking about how can we package investments in a way that makes them feel institutionally appropriate. So some years ago, we decided that we liked the combination of factor investing, trend following, and risk parity.
Mhm.
And to start with, we took out each of those things separately to clients. And what we found was that they would cherry pick. And they wouldn't necessarily cherry pick consistently, but they'd say, one might say risk parity is just a bet on bonds. And one might say trend following is a black box. And another might say factor investing is a fad that's going to fall over next week. And all those things have probably had some sensible intellectual backing behind them. But we found that we would keep on kind of being cherry picked. So what we did was we went away and we found 3 fantastic systematic managers that we could build diversified programs allocating to these 3 strands, putting them together into a very efficient package of diversifying risk premia, which we literally called diversified risk premia. And we then took it out to the client base as a package. And we had a lot of materials, there was a lot of training, a lot of heavy lifting, but we managed to get a big chunk of the client base to invest in those programs. And the returns that they've delivered over the last 9-10 year period have been fantastic on a risk adjusted basis, notwithstanding some pretty big drawdowns, which have been another behavioral issue, which we can talk about if it's interesting.
That is fascinating. And I think that sort of does beg the next question. So given clients are always facing an uncertain future, backtests can only do so much. How do you help them think through, what might happen in the future and whether their portfolio is appropriately sort of positioned?
Yeah. So again, and I feel like I've been saying this all session, but hopefully that's what you got me for. Is it's again a big hallmark of the way we built the business. That once upon a time we used to talk a lot about a 3 risk lens approach. Now we don't talk about that so much. We talk about more a mosaic approach to risk. But there's no one good approach to risk. There's no one good model. So what we did is we built a sophisticated suite of models that between them would help people to gain comfort in what they were doing. So essentially a mix of VAR models, which can tell you what might or might not happen in a bad or a really bad environment, stochastic and deterministic shocks and scenario analysis, which can let you know how a particular portfolio would have performed in certain deterministic or historical environments, or indeed made up ones. If someone's worried about a particular made up environment, we can create that as well. And the third, which I think is the most important for particularly some of the endowment and foundation and wealth clients, is a long-term Monte Carlo simulation, which essentially says, what's my long-term probability of meeting my outcomes? And we've done that across the pension space. When we did it in the pension space, we created a metric called POP, which was the probability of paying pensions. And we would put all the assets and liabilities through this long-term Monte Carlo simulation to see. But the difference there was that we created a model there that was more sophisticated than you could normally work into a Monte Carlo, and tried to maintain some of the more sophisticated elements of our asset model when we did it. But all of that is great and is going to count for absolutely nothing without trust and a really capable consultant who's going to sit in front of you, be articulate and manage the situation well, and communicate to you and manage you through some of those behavioral aspects. And that's, we need to just have a fantastic team that understands these issues.
That is very, very good set of approaches to help people get over the line analytically. In one of the analyses is, let's say, public versus private markets. So how do you think about the role of private assets within long-term investing?
Great question. And I don't know if this is what you were getting at, Hartej, but I feel like it might have been, is that there is a behavioral drive ultimately to invest in privates. It's on some levels, it's much easier to invest in privates because you're marking to market much less. You're probably not going to draw down by as much. And there seems to be a kind of unspoken belief that these funds will just kind of quietly flight plan, quarter by quarter to the target returns that you've been promised, and you don't need to worry about it. And I think that they absolutely have their place. Private assets, what's the benefit of them? Ultimately, they access areas of the market that we can't access otherwise. Again, I was struck by Simon Pilcher's comment about only 13% of companies over a certain amount of revenue are public. Now, I imagine that actually if you aggregate up all the revenue, the vast preponderance of them are public. But nonetheless, his point is well made, which is that there are a lot of private companies out there and they're generally staying private for longer. So if you want to access that innovative part of the economy, you're going to have to do some private assets. So I think they've got a role to play, but I do worry a little bit that we're driving very hard into them, really, again, somewhat behaviorally driven, and on the back of what was a very, very strong period for these assets where the money that was allocated to them started relatively small.
And you're looking at the types of asset managers who you might be looking to appoint to manage those monies. I mean, the way in which you research them, is it any different to the way you might look at a traditional asset manager versus a private asset manager? Or is it very much the same type of manager research and the same type of due diligence?
So it's pretty similar in some ways. We use the same process. We have a 10 by 10 by 10 process, which is really focused on identifying the characteristics of managers that we think will win out through time. What makes an attractive and appealing, successful investment manager, and those should be persistent, appealing qualities. But at the end of the day, maybe the biggest difference is that in the public markets, people are going to pretty much always screen on performance because they've got it there. And actually, to be fair, in private markets, they're going to do the same thing. Now, we do our absolute best not to do that. One of the rules that we have that, again, is consistent across public and private is we don't allow teams to screen on performance. And I think that's quite a big differentiator, which, very happy to talk about in a bit more detail. But ultimately, what we're really trying to get into the weeds on is building a qualitative thesis and then coming back to the analysis and the performance data that we've got and seeing if that actually backs up the thesis that we've independently come up with.
I think that's fascinating about not screening on performance. What's the rationale for that?
Okay, you're gonna get me on my soapbox now. So there's loads of papers that show that screening on performance is terrible because you just expose yourself to mean reversion. I mean, so that's the first point. But secondly, I think what's become really worrying is that people go to great measures to convince themselves they're not screening on performance. You've all seen it, you get in a room and when people start talking about Sortino ratios or, Kalmar ratios or upside downside capture ratio and things like this. And fundamentally, to some degree, it's nonsense. Like there's one string of numbers, which is a performance stream, and it's either a good performance stream or a bad performance stream. Now, I accept that you could probably show me a couple of different ways of getting to a very similar result that might look slightly better or worse. But fundamentally, you're cutting the same string of numbers into a whole bunch of largely meaningless sub numbers to convince yourself that you're not screening on performance data, which is what you are doing. So we just start from the perspective that there is no value in that. We all know, again, that you would need, I think, 20 years of data to actually prove skill. So there's no point in us trying to do that. We have to start from a qualitative approach, which says, what is the type of organization, what is the type of environment that a successful investment manager is likely to be found in? When I say it like that, it's more like bird spotting, right? It's like, where am I likely to encounter, a crocodile, right? And I think people are looking for crocodiles on the A3 to some extent.
So you could cut that a couple of ways. You could say you're likely to find excellent investors in a place where, let's say, there's a good culture, or they have very high quality people as defined by your criteria, or a very analytic process. Is there anything that let's say, you really look for, do you think other people are overlooking within sort of good managers?
I don't think any of these things is completely unique. I think there are people out there looking at most of these things, but whether they would place the same focus as us, I don't know. That alignment and autonomy are very, very important for certain types of business. But again, coming back to the point, you've got to look slightly differently between private and public assets. You've also got to look differently between income and equity. So, what you're looking for in a fixed income shop, people who work in fixed income want slightly different things. They are not taking the same, very PM-led conviction bets. They're making their money in a very different way. So you just have to think about, what's the ecosystem that's going to support that and allow me as a talented portfolio manager to deliver good results and continue to want to operate there. And that's not to say that they will forever, right? You have people who spin out of places all the time. So if you say, like, well, what do we do differently? I think one of the things that we are prepared to do is we are prepared to take relatively early stage risk on public managers. We know them well. And when you've gained comfort in their ability through time, then we will be prepared to back them with relatively big amounts of money when they're running relatively small amounts of money. It's going to manifest itself in great commercials, great alignment, but it's also going to manifest itself in a lot of key person risk. And I think as a whole, again, key person risk, people talk about being something of a pejorative phrase. To me, key person risk is just another risk premium. If you invest in a concentrated portfolio run by a very talented individual, then you are hoping to harvest a risk premium from that key person risk. And what you have to think about is, and this is going to probably lead on to maybe another behavioral point around how we exit managers. So we have to think about what's going to make us change our mind in the future. And that's really, really important for us as well.
We mentioned earlier that obviously Redington has just been bought by Gallagher UK. I mean, obviously a very exciting acquisition for yourself and the employees at Redington. What's that going to do to the likes of, how's that going to help and improve the resources that you have, the expertise, the additional knowledge, etc.? What's that going to look like? What's the future of Redington under the Gallagher UK umbrella going to feel and look like?
I guess there's a couple of things. So we were acquired by Gallagher about just over a year ago. So it was half term last year. I had flew back from my holiday to help break the news to everybody. So we've been under the Gallagher ownership for just over a year, but we retired the Reddington brand very recently, and so that's been sort of a big change for us. Going away from the name. And as I say, look, on some degree, there's a certain feel to that for those who've been with the brand a long time. But I think, Gallagher has a fantastic brand. Gallagher is everywhere, and there's a huge opportunity for us, I think, both here and globally. Gallagher is nearly 65,000 people, 65 billion market cap. So just having those resources behind us, the strength of contacts that they've got to allow us to leverage those relationships and get better knowledge of what we do, and this fantastic process that we've got that I've been talking about. We're really excited about the ability to sort of take that out and take the band on the road, as it were.
And Gallagher is very much from the insurance side of the industry. So do you see yourselves growing more in the insurance space and being able to provide a much better proposition to the insurance industry, whilst also obviously having to look after your pension clients and your wealth managers, etc.? How is that all going to sort of feeding together?
Well, I think I'm a big believer if you're not growing, you're shrinking to some extent, right? We've grown this business very successfully. I think Reddington had £4.5 million worth of revenue when I came on board, and today we're somewhere close to 10 times that. So we've managed growth very successfully without compromising on the advice that we give clients. I think that's the first thing. So you have to know that to be able to have comfort and confidence to go forward and continue to grow. But I think looking more broadly, I think about insurance companies. Clearly, Gallagher is a fantastic provider of risk management services into that market and is hugely well connected. And a lot of insurance companies, as Hartej will well know, have got very capable, sophisticated in-house teams that I think we're very well placed to work with. Not probably in exactly the same way that we work with our pension scheme clients, as we alluded to earlier. But yeah, I'm certainly hoping that we're going to be operating across broader shores and broader ranges of clients, across all areas.
I think one of the points is, do you think there's a similarity or a convergence even between what's happening in wealth management and insurance and pensions? Like, is that being thought of as one sort of large pool of capital?
Well, there's the client types that are more similar for sure. And, we definitely do think of clients who have defined liabilities, actuarial liabilities, as I said earlier on, differently to other clients. So the way I would broadly characterize this, and I'm somewhat nervous about saying this, I feel like Hartej might say that's the dumbest thing I've ever heard here. But the way I think about it is like, are you trying to minimize your risk for a given return that you need to achieve? So I see that as kind of landing your plane on an aircraft carrier, which might just be the fact that, Top Gun's probably like my, second or third favorite film. And that's really defined benefit pension investing. Insurance, life insurance looks a lot like that, obviously, right? You're trying to optimize to hit those cash flows. You don't want to take excess risk. And so it's really about hitting a return target, but then really trying to minimize that risk budget. Our other side of the book, across wealth management, endowments and foundations, and possibly some shorter tail insurers as well, is going to be much more about, here's the risk budget that I can afford. And now please go and help me maximize the return that I can achieve based on that. So we use the same process. They're two sides of the same coin. You can use the same process, you can use the same systems, you can use the same market assumptions, et cetera, but the actual portfolio construction and the way that you think about those two outcomes and setups is slightly different.
That's actually an excellent analogy. So thank you very much for that. Can I just ask one follow-up? How do you ensure the alignment of interests? So obviously you're making proposals. How do you make sure that, let's say, there's some sort of follow through in terms of performance and alignment?
Look, I think the easiest way to say that is that almost none of our clients have any lock-ins, and those who do have lock-ins, they're very, very short. They might be 3 months or 6 months. People have almost no notice in this game. So although it's an attractive business because we think it's, generally speaking, recurring revenue model that we have from our advisory business, but people can walk away from us very quickly. The other thing I would say is that one of the big challenges in this industry was that people really, I think, have tended to try and get people in on a kind of, what's the right word, like a bit of a teaser fee. And then, they hike the price up, or they hit them with things that they didn't think they were going to pay for. And that was something that we saw a lot. Got a great anecdote on that if you want to hear it. But
Go on then.
Please.
Go on then. Give it to us.
so we were pitching for a client back in, I think, 2016, and they asked for an all-in fee. And by that point, we were almost exclusively offering kind of all-in fees. So all-you-can-eat retainer, where you pay us a certain amount per year, and we will do everything. We're not on the clock. And the client came back to us and said, "Oh, these two other large consultancies have offered us fees that look much cheaper than yours." Well, are they all in? He said, "Well, they say they're all in." So, well, why don't we give you a list of everything that we think is sort of in scope? We think everything's in scope, but why don't we give you a list of all the things that we think are going to be in scope for this retainer? And he went back to those two other advisors and asked them to quote on that basis, and their quotes went up nearly tenfold.
Interesting.
So when you think about alignment of interest, there is, unfortunately, there has been, a tarring of this industry, with this sense of kind of, we're going to put you on a very low retainer, and then we're going to hit you with unexpected charges for this extra report or this manager selection exercise and so on. And we've done our best to get away from that and really just work in collaboration with clients.
And that's what clients want, right? I mean, they want to know full transparency and what they're going to get for the money that you're going to charge them. Just thinking, so Redington was seen as a leader in sustainability. Obviously, now moving across and under the Gallagher UK umbrella, how does sustainable investing, do you think, will play into your decision making going forward? Is there any changes, or is it just everything is normal?
So I think the thought leadership is still very much there, and we continue to want to push a very, very high bar on sustainable investing. I think we all continue to think it's extremely important. I think that ultimately we need to be clear, and I think we always have been clear, but I think we do need to be clear that these elements are client choice, and you can't force a certain type of advice down a client's throat. Now, happily, I think in the UK, the vast majority of clients are really progressive on the sustainability side, and generally speaking, they want to push to do more and do better and outdo each other. But fundamentally, we really want to focus on real world outcomes. Personally, I'm not a massive fan of divesting from assets. I think there's other ways that you can approach the problem. But no, I think it's going to continue to be a very, very significant part of our business, and I expect it's going to be a big driver of business growth in other regions as well.
And I guess, how does that go into net zero? That's obviously a very specific commitment that has been made, or certainly a target by many in the US and Europe. How do you put that decision to clients, and what sort of supporting evidence might you provide them to either decide to go with it or not to go with it?
Yeah, I mean, look, again, I think there's a multiple lens approach here, right? So we would encourage people not to anchor themselves completely to one lens if they can avoid it. And we have had some clients who wanted to be very, very ambitious on net zero targets, and for good reason. I would say that some of the challenges with that are challenges that we've seen play out in the last couple of years, which is that if the market moves the opposite direction to the way that you're anticipating, you can find yourself in a position where you're having to make difficult asset allocation choices, and you need to be really sensitive to that and understand what those trade-offs are going to potentially mean for you.
That's very clear. And obviously, there's a sort of winds of change in general, both sides of the Atlantic, in terms of how people are thinking about that. So thinking about this side of the Atlantic specifically, it feels like a lot of your clients are UK based, or at least the DB pension ones. How are they thinking about investment within the UK?
Yeah, again, great question. And I think to some extent it comes back to some of the same points around sustainability and divestment, right? Which is that, I think you want to be thoughtful about how you're investing in every region. I think you want your capital to count for something. And so, although I think the UK is a reasonable bet from a public market perspective, I think if the government wants us to invest more in UK public markets, they need to be thinking more about carrot rather than stick. But, in private assets, there's a huge opportunity to really define your own outcomes and invest capital, which is truly accretive to the ecosystem in a way that investing in a company that's already listed just isn't. So I think, it's not surprising that focus is likely to continue to be on private markets, although again, happy to talk about publics more if it's interesting.
I think the regulatory and political risk is something that's sort of come up I guess, do you see that within your book of clients, and what might help sort of overcome some of this regulatory and political risk?
From the perspective, I mean, I think what you're saying, it's difficult to get enthusiastic about investing in an ecosystem where everything seems to be changing and there doesn't seem to be that much. Is that fair? Yeah. I mean,
Absolutely.
I think it is difficult. I think it is difficult. If you look at this year where we have had, as a result of this tax commitment that Rachel Reeves made in the pre-election manifesto, we have seen a series of kind of increasingly kind of esoteric taxes floated in the press, from, mansion taxes to wealth taxes to now exit taxes. I'm not saying any of those things are good things or bad things. I think ultimately, clearly there needs to be some more money, but I also think there needs to be a bigger focus on spending. But it's very, very difficult to get enthusiastic about investing in an ecosystem when you don't know what the rules are. And I think the government has to be really, really clear about that. I just came from a lunch at the House of Commons where I have to be careful what I say because it was Chatham House rules, of course, but someone from a big global DC player was talking about the incentives that exist for investing in their domestic equities. Now, we don't have that. We have a disincentive. We have stamp duty that's charged on domestic equities. So again, big believer in behavioral finance, big believer in the undercover economist, and ultimately incentives drive outcomes. Like, if we want to drive outcomes, we have to look at what the incentives are and think about how we create better incentives to do what the government would like us to do. And I think stability around the ecosystem and thinking more about carrots rather than sticks is a better way to go.
And I guess just one question on sort of the earlier part of your response. Do you think that there are enough incentives or even positive incentives to invest in UK venture? So taking very, very early stage companies to maturity? Because apparently the UK has a very, very low allocation versus the US in similar type of institutions.
Great question. So my understanding, having seen some numbers on this, is that relative to GDP, we invest similar amounts of money into very, very early stage companies. And that is actually helped and really encouraged by the EIS and SEIS frameworks, which are a great example of carrot over stick. And I think they work very well. I've invested personal money into those things, and you know what? Lost quite a bit of it and had a couple of things that have worked out pretty well, but I did it because I was tax incentivized to do it. My understanding from the numbers I've seen is that it's really scale up capital and later stage VC where we're way behind the US, and where I think the US has something like 3 to 5 times the amount of money invested into this part of the maturity spectrum. And what that's leading to is companies who are really exciting for this country being bought by US strategics or US venture or PE players because the capital doesn't invest. So there isn't sufficient capital to support their continued development and growth in the UK. And I think that is clearly not a good situation, and one that we need to think really hard about. And we are thinking about that really hard as a firm, and how we can help clients get confidence around this part of the market.
So I'm going to take you back and just think about your time in the industry, your time working on the investment consultancy side. Can you sort of recall a decision that you might have made, or something that might have happened in your past where you've sort of learnt from what happened, how you did it, how you went about it?
Yeah, and this is one I talk about a lot when I do a breakfast for our grads every year, and I talk a lot about, I'm sure you read the book, The Chimp Paradox.
Mm-hmm.
And I talk about the chimp paradox because I have definitely struggled with the chimp over the years. And I've been lucky enough to work with a lot of colleagues who have understood the chimp. A great book, by the way. There's also a children's version of it I just recently found out. So if your children like mine are struggling with their chimp, then that's a great recommendation. I remember going to the first investment committee meeting that I ever went to as an advisor at Reddington, and we were making a recommendation. And it was quite a sophisticated recommendation. There were a lot of questions that came up against it, and I took each of them quite personally. And I took each one and sort of tried to debunk it, and then I'd get hit with another one. And I found myself just getting increasingly sort of frustrated and thinking, like, these people don't really want to take our advice. And what I learned from that, and eventually transposed into my consulting style, and hopefully our consulting style as a firm, is that it's a conversation. So let's let everyone get their points of view on the table, and then let's have a debate about it and see who else wants to contribute. When I've got all the points of view on the table and everybody's got their cards, then my ability to pull the strings together and to focus on the really important points, tease the really critical points out, rather than maybe some of these more knee-jerk or behavioural reactions, is going to be much, much stronger. And that's been a really clear learning for me in my career.
So interesting on that point. So is that something in terms of advice that you might give someone early in their investment career? How would you go about sort of saying to someone who's about to look at the investment industry as something they want to work in? Or indeed, if someone's already working within the industry, what sort of advice would you give them?
Well, I think the point I'm trying to make, and I try and make it a bit more specific as advice, is that investment is a really grey area. What's really fascinating about it is there's no one solution to anything. There's really a whole range of solutions to every question. And I think that's one of the reasons I enjoyed it, because I studied economics at university. Economics was a subject that I really enjoyed as a kind of mix of art and science. There's a lot of science to it, but the answers are often, quite sort of art. And investment is like that. So I think my point is there's no one right answer. We're all just having a philosophical debate. And so don't take people's perspectives personally, just try and learn from them. And then let's get the discussion going and see where we end up. And the challenge is really keeping that outcome, keeping that objective in your mind and thinking, how do we move towards that objective? But again, the lesson is really don't take it personally, because people's different perspectives are what make a market, right? That's why the market goes up a bit one day and down the next, and so on.
So true, so true. Okay, so we're just coming towards the end, Pete. I think probably one final question would be, what would you want your legacy as a CIO to be? What would you want it to look like?
Well, I think the great bit of this job is, there's a whole bunch of great things to this job. I would say, the fact that every day is different, the fact you get to work with so many fantastic people. But the problem solving, which really has worked well for my intellectual curiosity, is probably the bit that I have enjoyed the most. And so, I think if people said he was a great person to have in the room when we had a really tricky problem, I wouldn't have wanted to try and solve a tricky problem without him in the room. That'd be a great hallmark.
Fantastic. Listen, it's been a fantastic interview. I've really enjoyed it. We always end with a quick fire round. You've listened to Simon, right? So you know what's coming next. So it's all about favorites, right? So favorite sport.
Well, I have rugby for me, but the problem is my eldest has just started Sussex cricket and he's absolutely loving it. So I'm going to have to get a bit more into my cricket. But for me, rugby.
Excellent. Favorite film or TV drama?
Well, I mentioned Top Gun earlier, but no, probably Heat is probably one of
Great
my
film,
all-time favorites.
Great
Yeah,
film.
great.
Favorite drink?
Favorite drink? Well, my colleagues would be totally disappointed if I didn't say Pepsi Max, which there was a point where I used to take delivery of it by the pallet to our Angel Court office. But I have actually recently this year switched to Diet Coke. So probably have to say that, I'm afraid. Rather boring.
Very good. Favorite book?
Favorite book? I mean, so many, but I would say one I've just finished, which is 1929 by Andrew Ross Sorkin, which I have to say does have some interesting parallels to the place that we find ourselves in today. So again, yeah, great read for anyone who's, a student of history, student of markets.
Fantastic. And favorite hobby?
Favorite hobby? Oh, we got to do the surprising one. I mean, I don't get as much time doing this as I would like to, but my dad is a huge war gamer, by which I mean, he gets all these toy soldiers out, spreads them all over a humongous table, and replays historical battles. And I do a bit of that with him, and it's great fun.
Fantastic. Brilliant. Yeah, Pete, thank you so much. We've thoroughly enjoyed it. We look forward to speaking to you again sometime soon.
Thank you.
Great fun. Thank you very much, gentlemen.
Thank you so much for listening. Be sure to stay tuned. In the meantime, follow the CIO Investment Club on LinkedIn, Threads, and X to stay in the loop about our upcoming guest interviews on the CIO Chair podcast. For more information about us, please visit our website at www.cioinvestmentclub.com. Thank you and goodbye.